Hello everybody, Ignatius Subjects and CPA PFS here. Today we're talking about stuff you can do before April 15, 2026 that still counts towards 2025 tax year. There's a few cool things, Roth IRAs, traditional IRAs, HSAs, health savings accounts, Coverdell ESAs, etc., etc., etc. Okay? Not really, etc., etc., etc. That's pretty much it. But go ahead and stay tuned. We're going to be right back in a second. All right, everybody, we're back. So again, by April 15th, 2026, you are able to contribute to a few accounts that still count towards 2025 tax year and can help to save you on some taxes in some cases they won't save you on taxes today, but they might save you on some taxes in the future. Hopefully they will save you on taxes in the future. So they're still worthwhile to take advantage of. Okay, so let's go through and start talking about IRAs first and foremost, okay? So for IRAs, depending on your income and depending on if you're qualified or if you're participating in another workplace retirement plan or anything like that, right? You can typically contribute to an IRA and take a tax deduction for a traditional IRA before April 15th, 2026. Now, if your income is above a certain threshold or you participate in a workplace plan, you may not be able to deduct it and you can still contribute to one. It's just going to be a non-deductible contribution to that IRA, okay? Now, if your income is below a certain threshold, which just happens to be $236,000 if you're married filing jointly and $150,000 if you're single, then you can actually contribute to a Roth IRA directly and just put money directly into a Roth before April 15th, 2026, okay? Now, if your income's above those thresholds I just explained on the Roth IRA, then you probably want to go ahead and do a backdoor Roth contribution so that you still get the benefits of doing the Roth for the most part. And there's a couple things you have to be worried about there. Obviously, if you have other traditional IRA dollars, then doing a backdoor Roth conversion is going to result in you paying some income taxes in the 2026 tax year later on, sometime next year. So you have to be a little careful with that. But if you go into it with open eyes and understand what you're doing and the implications of that, it still may not be the worst thing in the world to go ahead and do it, okay? And I have other videos that explain why that is and why I am a huge believer in Roth accounts compared to other traditional accounts. And yes, I believe a lot of people in the financial world have this one completely wrong because there's more to it than just income taxes, people. There's more to it than just how much is your income tax rate today versus your income tax rate when you retire. There's several other considerations you got to think about and consider when you're considering Roth versus traditional. And oftentimes people don't talk about those. And so go look at my other videos. A lot of good content on that. Check it out. Okay, so you can contribute to either of those accounts, traditional or Roth, $7,000 if you're under the age of 50 or $8,000 if you're 50 or over. And it's based off of your age at the end of the tax year is how you determine how much you could put into an IRA account. Okay. Now, for other income thresholds on the traditional IRA in terms of deductibility, go ahead and look it up online. There's a lot of different varying income amounts there, so I'm not going to go through all those, but just go ahead and check it out online. It's a lot of cool stuff there, okay? So moving on. That's the Roth IRA, the backdoor Roth, traditional IRA. Now, how do you do backdoor Roth? Okay, let's talk about that for a second. There's a few steps. First step, contribute the money to a non-deductible IRA. Okay, first step. Second step, convert that non-deductible IRA to a Roth IRA, usually a few weeks or a few days, few weeks down the line. I wouldn't wait too long because you want to take advantage of that growth in that tax-free account, right? So contribute to the non-deductible IRA, then convert it to the Roth IRA. That's that. Next step, you have to make sure that you report that on a form called Form 8606. Very, very important that your accountant or whoever's doing your taxes, or if it's you yourself, that you make sure your tax return includes Form 8606 showing that you did a non-deductible contribution for 2025 tax year, even though you made the contribution in 2026. It's going to become really important when you go to file your 2026 tax return, because on your 2026 tax return is where the conversion will show up, where you converted it from a traditional IRA to a Roth IRA, okay? You're going to receive a 1099-R in 2027. That is for 2026 tax year. That will show that you converted however many IRA dollars you put in, right, from traditional to Roth. And Form 8606 is going to determine how much of that ends up getting taxed. Hopefully nothing if you plan this correctly. And there's ways to get around having to pay taxes on your traditional IRA balances. One of the easiest ways, move it into a 401k. Other than that, right, there's some other things you could do, but we're not going to go into those right now. So the most important thing is any IRAs you have, any pre-tax IRAs, whether it's a SEP IRA, simple IRA, traditional IRA, you have to be very careful with that because you will potentially have to do a pro rata allocation and convert some of those to Roth dollars and pay some taxes on some of that money. Okay. That being said, still a good strategy, still a good opportunity to take advantage of, and definitely look at doing some sort of strategy related to it. If you're looking to do the backdoor Roth, I highly encourage you to talk to someone about it so you make sure you don't get to the end of 2026 and you end up owing a bunch of money in taxes that you didn't plan on owing. Okay? But if your income is below those thresholds, don't have to worry about backdoor Roth. Nice and easy, simple. Just go ahead and contribute directly to the Roth. Now, what happens if you put money into a Roth IRA and you weren't eligible to? Well, you have to correct that typically before your tax return due date. And you get extensions on that as well. But you have to correct it before your due date. Otherwise, you have to pay a penalty. So correction means pulling it out along with any earnings. And if you did make any earnings, then you're going to have to pay taxes on that when you go and do your 2026 tax return. Okay, so that's really it on the IRAs. I do another video, like I said, that goes into more details about the cool nature of IRAs and things you can do with those, so I'm not going to get into that. Main thing I wanted to stress is for the tax deadline coming up, you have until April 15, 2026 to still contribute for tax year 2025, and it counts towards tax year 2025 in terms of deductions if you want traditional IRA deductions, or if you don't want those in terms of just contributing to the Roth IRA. Okay, now let's talk through health savings accounts. So for your health savings accounts, here's the limits for 2025. $4,300 if you're individual. Okay, no family coverage. And if you have family coverage, $8,550. Okay, so if you're age 55 or over, you can contribute to a HSA and put an extra $1,000 into it. Now, for 2025 tax year, that still has to be into its own separate account. So you and your spouse, if you're both over 55, you both have to have your own individual HSA account for tax year 2025. Starting in tax year 2026, they changed that rule to where now you can just put everything into one account, whether it's a husband or wife, whoever wants to have the account, or you could even switch off from year to year so that each of you has some in your own HSA if you want. But basically, you just put family coverage and you can contribute into each of your accounts, or one account even, the $1,000 for each of you. So the maximum contribution that's allowable for 2025 tax year is $10,550. Again, assuming you each have your own account. For 2026, that amount changes a little bit, so go look at those amounts if you want to. We're not going to talk about that on this video, okay? But basically, yeah, this is the last year we have to worry about that stupid rule. I don't know why that was ever really a rule, but going forward, you can just put everything into one account and you don't have to have separate accounts if you don't want to. So that's the HSA. Again, deadline April 15, 2026. Now, the cool thing about HSAs, you've heard me talk about in other videos, is you get a tax deduction for putting money in. You get a tax deduction while you pull it out, as long as it's pulled out for medical expenses. And medical expenses includes things like dental and vision, okay? And there's no taxes when it grows. So it's like the trifecta. You got the triple whammy right there, okay? So HSAs are pretty cool. Definitely go check those out. Pretty awesome to save you some money on taxes and help to save for medical expenses, which is going to be one of your biggest expenses ever in your life. At some point in your life, you're going to get sick. You're going to have some sort of illness. You're going to have something happen where you're going to probably have to pay a lot of money to some hospital or whatever. And this is going to be one of the ways you're going to be able to help pay for that, okay? Just something to put into your retirement plan is having a nice size HSA account, okay? They also expanded the availability of these accounts starting in 2026 as well. Actually, I think that may have started in 2025, so don't quote me on that. I'm not going to look that up right now. But where certain plans on the marketplace now qualify, even if they're not technically HSA eligible. So check that out, okay? But those are the limits for 2025, and you have until April 15th to contribute for those. The third thing we're going to talk about is the Coverdell ESA. The Coverdell Education Savings Account. You can put up to $2,000 into that account to help save for your child's education expenses. You can do this whenever they're born, basically, until they're like 18 roughly. So, and you can save for their college. Okay, so $2,000 a year going into a child's education savings account. If there are income thresholds, right? I don't know the income threshold off the top of my head. I'm not going to look it up. But if your income is above that threshold, it's pretty easy to get around. You can contribute technically from a company. You can also contribute from grandparent. You can contribute from the child themselves. The child themselves can actually contribute to their own education savings account. So there's really no excuse on not contributing to an education savings account, because the investment options under those accounts are a lot better than a 529 plan. So if you're going to save for a child's education, as I did in a recent video, I would do the Coverdell first. If you still have more money, then go to a 529 plan. Okay, but again, in my order of priority, 529 plans are at the very, 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 very bottom of the list. So that's just me, but everyone's different. So you can make your own decisions. Anyways, so those are the 3 key contributions that are still available through April 15, 2026. Feel free to go ahead and do any of those, all of them, max them out, do a little bit of each, however you want to kind of break it up. You have a little over a few weeks here to go ahead and do that. So thanks for tuning in today. If you have any other questions or anything like that, feel free to leave a comment, ask away. Depending on what it is, I'll get back to you, or someone from the team will get back to you, and we'll go from there. So hope everybody enjoyed this video, and hope you have a great one. Go ahead and watch some March Madness, and peace.
This presentation is intended to be educational only and does not constitute a CPA or financial advisor-client relationship. It is always in your best interest to consult a competent legal financial advisor and/or tax professional when conducting your own personal transactions. Furthermore, it's important to do your own research when necessary to verify tax law when there's a lack of concrete guidance or gray areas of conversation.